Welcome to the Opening Bell Report.
Today, we're tackling something that I think anyone who invests has felt.
Oh, absolutely.
That really stomach-churning feeling when you open your portfolio and just see red. We're plunging into a recent analysis report on American Bitcoin Core, that's ticker ABTC.
Right.
And it just took a sharp hit. It slid down nearly 6% to $1.76. And if you're holding that, I mean, that's an alarm bell.
It is. But what's so fascinating about the analysis we're looking at is that the authors, they completely refuse to panic. They don't see this drop as a failure at all. Instead, they take this profoundly contrarian stance, super bullish.
What are they saying?
They're arguing that this isn't a crash. It's not even a real correction. It is, and this is their exact phrasing, the golden buying opportunity of 2026.
Wow. That is a staggering claim to make. It's pretty hard to look at a number like -6% and see gold.
It is.
So our mission today is pretty clear. We have to unpack the specific arguments, financial, strategic, technical, that this report is using to justify that kind of conviction.
Exactly. They're telling you the entire market is wrong right now. The central conflict is just so stark. You've got nervous investors seeing $1.76 and, selling out of fear.
Sure, panic selling.
But the report claims this whole thing is a calculated move. They call it a bear trap.
A bear trap.
Yeah, designed supposedly by market makers to intentionally create panic and force the short-term shareholders to just sell off their positions cheap.
So the big money can scoop them up.
That's the narrative. So we really have to dissect the logic here. Does the foundation actually support this idea of, manipulation and extreme undervaluation?
Okay, let's do it. Let's start with the fundamentals, because that seems to be the first core argument in the report. This massive disconnect between the price, 176, and what the company is actually doing.
It's a huge disconnect. I mean, the market seems to be pricing it like a company that's struggling, but the financials tell a completely different story, a much healthier one.
And that data, that fundamental data they cite, it's really the bedrock of their whole argument, isn't it?
It absolutely is, and for good reason. When you actually look at the financial results, the growth figures aren't just strong, they're dramatic.
How dramatic are we talking?
ABTC reported a massive 453% revenue growth year over year.
453%. We have to pause on that for a second, because that's not incremental growth. That is exponential.
It is. It's an explosion.
So in a sector like crypto mining, which is just brutally competitive, how does the report frame the sustainability of that kind of number? Is it a one-time thing?
That's the critical question. And the report kind of addresses that by focusing on two things. First, yes, the growth is explosive, and it brought their total revenue up to $122.5 million. But the real key here, and what makes them different from so many competitors, it isn't just the revenue, it's the profitability.
Meaning the money they're bringing in is actually staying in the company.
Precisely. Unlike so many other miners who are just burning cash to scale up, ABTC is actually profitable. They're posting a real net income.
And that puts them in a whole different category.
A completely different category. It means they're generating cash flow right now, which gives them a stability that a lot of their peers just don't have.
That's a huge distinction. It suggests they're at least partly insulated from some of that crypto volatility. But, growth and profit don't mean much if the stock is already overpriced.
Which brings us to valuation.
Yep. And this is where the report deploys its favorite metric to argue it's undervalued, the price-to-earnings ratio. The PE.
Right, the classic PE ratio, how much you're paying for each dollar of earnings.
And according to the report, ABTC's PE is sitting at just 9.8 times earnings.
9.8.
To them, that is the smoking gun. So why is 9.8 so significant? Especially for a company that's showing, 453% growth?
It stands out because of the context of the sector. The analysis points out that rival companies, other crypto and tech growth firms, they often trade at multiples of 20, 30, sometimes even 50 times earnings.
So you're saying it's being valued like a slow-growth utility company, but it's growing like a tech startup.
Exactly. I mean, that's the disconnect. The report just flat out says ABTC is dirt cheap right now. They're arguing that the stock is priced as if it's in decline, not in the middle of this explosive growth.
And the assumption is that the PE multiple has to correct upwards, eventually.
It has to. And that provides the first major leg of their whole upside argument.
Okay, so the fundamentals are screaming buy, according to this analysis. But fundamentals alone aren't always enough, especially in a sector that's so narrative-driven. This brings us to the second pillar of their argument.
Right.
The so-called secret weapon on the company's balance sheet.
The secret weapon. This refers to their very deliberate strategic pivot. They're focusing on building a significant strategic Bitcoin reserve.
So they're not just mining Bitcoin to immediately sell it for operating costs.
No, not at all. This is a strategy to accumulate the asset itself, to tie the company's long-term value directly to the future price of Bitcoin.
So they're shifting from being just a miner to almost like a digital asset treasury manager.
That's a great way to put it. And that completely changes the investment math when the stock price takes a hit like it just did.
How so?
Well, according to the report, it creates a kind of protective floor under the stock price. When the stock drops to, say, $1.76, its market cap momentarily disconnects from the actual value of the Bitcoin it's holding.
So the company's stock becomes temporarily worth less than the assets it owns, not to mention its profitable mining operations.
Precisely. So the conclusion they draw is that investors buying at this depressed level are essentially getting Bitcoin exposure at a discount.
You get the growth and a discounted crypto treasury.
That's the idea. The reserve acts as this intrinsic value buffer that makes a 6% dip look, fundamentally illogical.
It's a great way to frame it. It's not a risk. It's a pricing error caused by short-term panic. But of course, timing is everything.
Always.
And this is where the analysis brings in technical indicators to argue that right now is the perfect time to get in.
Yep, they're very clear on their timing signals. They use two main technical indicators. First, they point to the Relative Strength Index, the RSI.
The RSI.
Which is, and I'm quoting here, flashing oversold.
Okay, for anyone who doesn't stare at charts all day, break that down for us. What does an oversold RSI actually mean?
Sure. The RSI is basically a momentum gauge. It measures the speed and size of price changes. When it drops below a certain level, usually 30, it suggests that an asset has been sold off too aggressively, too fast.
And a rebound is likely.
A rebound or a mean reversion becomes statistically very probable. It suggests the selling pressure might just be exhausted.
So the market has basically run out of people willing to sell at 176.
That's the theory. And secondly, the report states the stock is sitting right on a key historical support level.
And what's the history there?
They reference the last time the stock hit this exact same level, which was back in December. And right after it hit that floor, it had a massive bounce upward.
So they're leaning on that old market saying.
They are. They even use the phrase, history doesn't always repeat, but it often rhymes. The technical picture for them strongly suggests this isn't a floor crumbling, it's a springboard.
Which, if you believe the bear trap theory, means the trap has now been sprung. The weak hands are out.
And the sophisticated money is supposedly ready to accumulate. The downward pressure is gone.
Okay, so if the past and present look that strong, let's talk about the future. What's the actual payoff here?
Yeah.
If you do buy in at 176, where do the analysts think this is going?
The expectations are quite high. The consensus rating across the board is a strong buy, and the specific number they're all pointing to is a $4 price target.
$4 from $1.76. We should probably quantify that potential return because that's really what justifies calling this a golden opportunity.
The math is pretty attractive, yeah. If you buy at 176 and it hits that $4 target, that represents a 127% upside.
So more than doubling your money.
More than a 2x gain, as the report calculates it. And when you think about major indexes hoping for maybe, 7 to 10% a year, a potential 127% is why they're calling this an extreme opportunity.
And the report makes it pretty clear who they think is taking advantage of this right now.
Oh, absolutely. The core psychological message is that the smart money is already moving in while retail investors are selling in a panic.
So the institutions are buying what the individuals are selling.
That's the picture they paint. The institutions believe the stock is primed to fly, and their prediction is that it's going to move up fast, and I quote, leave the $1.76 sellers behind as soon as Bitcoin itself shows any strength.
So this dip is just the last bit of noise before a major move.
To synthesize the whole thesis of this report, that 6% drop is fundamentally irrational. The data points, the 453% growth, the super low 9.8 PE, the Bitcoin reserve, they all completely negate a tiny price fluctuation.
The argument is that sophisticated investors see this fear as a gift.
A short-term gift, and they are capitalizing on it while everyone else is scared.
Which really brings us to the final choice the analysis presents to you, the listener. It ends with a simple challenge.
Right.
You can either look at that red ink on the screen and let fear take over, and let the so-called market makers shake you out of your position.
Or you do what the analyst says wealthy investors do, buy when there is blood in the streets.
The message couldn't be clearer. Conviction in the fundamentals has to outweigh the short-term noise.
And this all raises a really important question for you to explore, one that builds on what we've discussed. Given the report's focus on that PE of 9.8 being dirt cheap, how much of that $4 price target is just based on fundamentals?
You mean if the market just corrects the PE to a more normal level for the sector, say 20 or 25 times earnings.
Exactly. Does that alone get you most of the way to $4? Or how much of that ambitious 127% upside is really dependent on the more speculative part, the value of that Bitcoin reserve and, the unpredictable sentiment of the crypto market itself?
Separating the fundamental value from the speculative upside.
That's it.
Don't forget to like, share, and subscribe for more.